Welcome, everyone. I'm Caitlin McKegg. I am a real estate broker here in Phoenix, Arizona. Thanks for joining us today on this Monday market update. As always, I'm going to talk about what's going on in the economy and what's going on in the Phoenix real estate market because it all affects one another. And today I'm going to tell you something that you may like, you may not like. Time will tell, but hear me out. We are seeing some interesting things happening in the Phoenix market. In terms of things taking off. So we'll get there in a second. Let's start with the economy. Last week we had the PPI numbers come out, which is the producer price index, basically wholesale prices, which fell 0.5% in December, which is more than expected. That's always good news. Retail sales also fell 1.1% in December, slightly more than the 1% forecast. So bottom line here, it's good news showing that inflation is easing. This is another measure that the Fed looks at. The decline was the biggest on a monthly basis since April of 2020. So good news here. Why does this matter with real estate? Because it affects the Fed's decision on their next meeting. And if they continue to increase rates or hold them or don't do a rate increase, all of that eventually affects the mortgage industry because it affects the markets, et cetera, et cetera. So let's talk about the Fed. They have a meeting on February 1st. Fed sets course for a milder interest rate rise in February. This isn't new news. I've been talking about this for a few weeks now. The anticipation is that the Fed will raise the federal funds rate 25 basis points on February 1st, which is much milder than the 50 and 75 basis point hikes they've been doing last year. And they're talking about how it takes time for the full effect of higher rates to cool economic activity. And they are kind of slowing the pace to give time to assess the impact of their increases and determine where to stop. So that's really good news to hear. I've mentioned that there's been some concern that maybe they were a bit too aggressive and really not seeing the effect of all of these rate hikes in the economy. And it's good to see that they're starting to just not pause, but slow down a little bit and take inventory of what's going on before they continue an aggressive path. So speaking of what the effects have been on the economy, layoffs. Some big layoffs have been announced last week. So if you were paying attention last week, you probably heard that Google or Alphabet announced a pretty big layoff. We also have seen Microsoft, Amazon, Salesforce, Vimeo, Goldman Sachs, Bed Bath & Beyond, BlackRock, the Bank of New York Mellon Corporation, Coinbase, all of them announcing layoffs last week and others as well. Those are just some of the larger companies, and many have been specific to tech. And so we're seeing this change. Part of this too is these companies hired so much over the last 2 years with the changes from the pandemic that as we settle back into a more normal economy, some of that sales force or workforce isn't necessarily needed. So that's what this article talks about. Big tech layoffs are not as big as they appear at first glance. And I thought this was interesting. They're talking about how 12,000 jobs is a lot of workers losing their jobs, number of hires at Alphabet or Google. But it's still less than the net number of hires that were made in just the third quarter of last year, which totaled 12,765. So Alphabet is laying off pretty much everyone they hired in the third quarter of last year. So again, 12,000, those are 12,000 people that are losing their jobs. We have to keep that in mind. However, in terms of numbers, when you look at that from a company standpoint, they're just kind of going back to where they were in the third quarter or second quarter of last year. So it's not the biggest change for their workforce, or so it seems. They continue to talk about how these numbers do sound crazy, but these companies are so large that it's such a small percentage of their workforce. Talking in here, those adjustments look large in terms of the number of layoffs, but not in comparison with the number of people hired during the COVID pandemic. The largest number announced by a big tech company so far is the 18,000 projected at Amazon, but Amazon hired hundreds of thousands of workers during the pandemic to grow into the second largest employer in the US. The company had fewer than 800,000 employees at the end of 2019, and the number doubled to more than 1.6 million at times last year. So again, you have to remember these are people losing their jobs, but these are small percentages of the overall workforce of these companies. So it isn't such a drastic impact on the company themselves. But the real question is, and it talks about this here, whether there's jobs out there for the laid off tech workers. The answer so far appears to be that there are. Job postings have stayed strong. Unemployment remains at a multi-decade low. Tech jobs have been increasing even as job postings in the industry have declined from record levels. So this will be something to watch. I do think that the labor force is something that is lagging from the impact of the Fed rate hikes as we settle into this new economy. So we'll see what happens with employment or unemployment, and but just something to keep your eye on. And so far, we've seen tech kind of getting hit the hardest with these layoffs. Now, all of this has been happening, right? We're seeing inflation start to come down, which is what the Fed wanted. We're seeing them start to slow the pace of their rate hikes. We're now seeing the labor market be affected. But what's happening with mortgage rates? Well, you might be surprised to hear that mortgage demand jumped nearly 28% last week as interest rates dropped to the lowest point in months. So last week I talked about how rates were at a 4-month low, and that has continued. And then we saw applications for mortgage to purchase home increased 25% week to week. Keep in mind, it is still 35% lower than the same time in this week a year ago. So we have not recovered all of that demand by any means, but we are seeing a huge uptick in people interested in purchasing a house. We also saw an interest in refinancing. So refinance demand made the biggest move up at 34% from the previous week, but it's still 81% lower than the same time a year ago. So we're nowhere near where we used to be, but we are absolutely seeing some recovery in demand from both a new purchase standpoint and refinance standpoint. So this is interesting to watch. Now, this is national news, but we are feeling the same thing here in Phoenix. And I'm going to talk a little bit about that. You may have heard the date May 10th thrown out there. So I want to kind of explain what that is. A lot of people in mortgage especially are talking about this, but the real estate community as well, talking about how May 10th is going to be a turning point for us to really start to see rates go down for mortgage rates. And the reason this is being predicted is because as we measure year over year inflation, by the time we get to May 10th, assuming we continue on the path we've been on this year, we will start to see a pretty significant gap between the 2022 inflation numbers and 2023. And so once that comes out, we'll be looking at the April numbers on May 10th when that comes out. We will likely start to see some positivity in the market, which will really affect and drop mortgage rates. So that in a nutshell is what people are talking about when they talk about May 10th being a turning point. So if you've been waiting on the sidelines to buy a house, you may start to see better rates after May 10th. That said, I don't know what will happen with home prices and demand and inventory before May 10th. So I'm not advising that you wait. I'm not advising that you jump in now either if you're not comfortable, but just some data points for you to consider if you're thinking of buying. And then on the seller side too, just thinking about maybe we'll see a pretty big uptick in demand as we go into the summer. So as a seller, you may start to see or have a better opportunity of selling in the summer, although summer is typically a little bit of a slower time for us here in Phoenix. So, I just threw a lot of counterpoints out at you. It is your decision to make, but that is the talk in the industry right now. So let's talk about what's going on in Phoenix. Before I jump into that, though, if this is valuable to you at all, give me a like. I would really appreciate it. And hit subscribe so you can be here with me every week to learn what's going on. All right, Phoenix, let's talk. So I follow the Cromford report. If you're new, they analyze data in the MLS and they have this cool little algorithm that lets us look at supply and demand in the market. And it is a predictor of price because it is showing us where supply and demand stand, right? So if we have more supply than demand, prices will likely go down. If we have more demand than supply, prices will likely go up. Any number here that is 110 or higher is technically a seller's market. So you may not believe your eyes, but we are technically in a seller's market in Phoenix by 1.2%. Now, this is looking at all of Phoenix Metro. We'll get into each city individually here in a second, but holy crap, that's all I can say. We were like in the 90s, I think 2 weeks ago. So yeah, that's a big number. That's different to see. You can see that supply has continued to go down. So our supply is about 33% below normal. And then our demand has started to tick up and it's only about 26% below normal. So these two indicators are moving away from each other, which is pushing the overall CMI up. Before we had these two indicators very close together, which was showing that we're in a balanced market. And right now we are moving towards a seller's market as these two indicators move in a different direction. So that's where we stand as far as the CMI, but let's look at per city because we can see this same chart by city, which I know all of you love. The change that we've had over the last week or month over month for this last week is 22%, which is the same that we had last week. So what that means is on average, all of these cities had a CMI increase on average by 22% when we look month over month. We measured last week, month over month, it was also 22%. I think the week before that, month over month was like 21%. So we had been increasing in the gains that we were seeing. This week is a little bit more stable, but still everything has improved for sellers. The green arrows mean that that is improvement for sellers further towards a seller's market. Now, keep in mind, we still have cities in a buyer's market. I always like to point this out, anything under 90. So Goodyear, Queen Creek, Maricopa, and Buckeye are all in a buyer's market still. Everything from 90 up to 109 here is a balanced market. And then anything above 110 is a seller's market. So we actually have the majority of cities in a seller's market, if you can believe that. So I know it's counterintuitive to what you hear in the headlines. I know it's a different message than what I've been saying over the last few months, but what can I say? Things have changed. Now, keep in mind, these aren't strong sellers markets either. We're just like barely out of balance. And that's more in terms of a technicality. So as a buyer and a seller in this market, I would approach the market as a balanced market more than anything, because if you're going to come in as a seller and assume that you can get anything you want from a buyer, you're wrong. And if you're going to come in as a buyer and think that you can lowball sellers and get anything you want, you're also wrong. So, of course, there are case-by-case situations there, but I would approach this, if I were a buyer or seller, from the standpoint of a balanced market, because that's essentially what we're in most of these cities. With the exception of, a house that's priced really well or underpriced and that kind of thing, all of those things, make a difference. But generally speaking, that's my suggestion. So what's been going on to change all of this? Well, we've seen a really big uptick in accepted contracts and buyer activity. So this was, I think 2 weeks ago, January. I think this was the week of January 5th. This is the highest number of accepted contracts that we've had in our market since August. So that's a pretty big jump. That's a pretty big change. Of course, in here in December, it's going to be slower and fewer contracts. But we really shot back up over anywhere we had been back into August. And so this happened. This information came out last week, looking at the week of January 5th. And then if we look at the number of listings under contract, this is some new news. This pink color is 2023. In the last week, 6,729 listings under contract. Obviously, we are much lower than 2020 through 2022 as we started the year. The activity and transaction volume is much lower. However, this jump between week 2 of the year to week 3 of the year is the highest percentage growth we've ever measured for week 3 over week 1. So 1 to 3. So where we started to where we're at on the 3rd week of the year is the highest percentage growth that the Cromford report has ever measured. And that's number of listings under contract. So that in essence is our activity. It's our demand. It's our buyer demand because they're coming out and writing contracts and making deals. So this is demand taking off. That's what we're seeing here. Now, whether or not that stays, whether or not supply stays low, because that's also low, that's not helping our situation here. All of these are other factors that could change where we're headed. But at the moment, what I'm telling you is demand is taking off. You don't have to like it, but we are leaving this dismal buyer's market thought that we've had for a long time, and there is a lot of strength returning to the market. So what does this mean for you? Well, if you're a seller, it means that good times might be coming. Might be coming your way. It might be getting easier for you. So if you've been thinking about selling, maybe think about it a little bit more seriously and try to catch this wave. I do have a link below for a free instant home valuation if you're just curious what your home value is. So check that out. If you're a buyer, keep an eye on those rates because rates have come down. They're the lowest they've been in 4 months. They've continued to trend down. Word on the street is that we will continue to see that. And again, keep in mind that May 10th date. So if you're serious about buying, you may want to really start looking into what you're approved for and what prices look like for you and all that good stuff. It's not going to hurt to just look into it. It doesn't mean you have to buy now, but at least get your arms wrapped around what you can afford and keep an eye on those rates. If you do want to search my MLS for homes for sale, I also have a link that you can use in the description. So check that out. But you guys, that's all I've got today. I hope it was helpful, interesting. Let me know in the comments. Do you think this trend of buyer demand takeoff is going to continue, or do you think this is a false alarm? I'd love to hear from you. Thanks for joining. I will see you guys again later this week with some more great info, and I will be back with another market update next week. I'm Caitlin McKegg with the Desert Dreamers team.